Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me? Please tell me. All right. Just 2 minutes. I'll be starting. So the topics for today are NPV, we started in the last class, IRR, annuity, perpetuity, and adjustments in the NPV. Interesting topics we have today. Now, so students, NPV. We discussed in the last class what the NPV actually is. We talked that NPV tells the exact impact of a project on the shareholder's wealth. We told that. The NPV of a project tells what we discussed in the last class, and how we have talked about that when NPV is positive, the wealth of the shareholder is increased. And when NPV is negative, the shareholder's wealth is reduced. We talked about these both. Now, for example, this is a project. Cash flows are negative 1900 million. Discount factor is 10%. And we have to calculate, we have to calculate its NPV. Discount factor, calculate present value and tell me its NPV. Be quick, everyone. Be quick, everyone. NPV of the project. Give me answer, please. NPV of this project. More answers, please. All right. So you have calculated the NPV everyone plus 618.7. This means the wealth of the shareholders of the company will increase by this amount, right? That will be the answer to this question. Now, students, the next NPV has advantages of NPV method and drawbacks as well. Advantages of NPV. It is a cash flow based technique. Cash flows based technique. Second, yes, it utilizes cash flow. It considers time value of money. We do discounting in it. Third, it considers full life of project. Full life of the project. Excuse me. Next. It is an absolute measure, which means it tells exact increase or decrease of wealth of shareholders' wealth due to a project. Absolute measure. Next. Absolute measure means which is telling the exact impact. It assumes excess cash flows are reinvested. Excess cash flows are reinvested at cost of capital, which is a realistic measure. Which is a realistic assumption. Yes. There's cash flow every year. They are reinvested. They are not kept idle. They are reinvested at cost of capital. Which is a realistic measure, realistic assumption. Now, next point. Drawbacks, downside. There is no as such downside, only one. It is difficult to conceptualize for business managers. It is difficult for them. Normally, they are unable to understand the concept behind it. Now, next. It is done. Any confusion, anyone? Is it clear? Tell me, please. Is it clear? Is it clear? Good. Now, let us proceed further. IRR, internal rate of return. IRR, internal rate of return. Student, IRR or internal rate of return of a project is basically, it is average annual return from a project. Average annual return from a project. Now, so IRR, internal rate of return, how it is calculated from the project? IRR is equal to lower rate of return plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. This is IRR formula. Please note down, everyone. Now, means that we need two NPVs at two different rates. Just see here. For example, I will explain IRR. Hold on, please. What happened? Yes. We have a project 2500, 700, 890, 950, 1120. Students, give me its present value or NPV at 12%. Tell me, have you got notes, everyone? Notes volume 1. You have obtained the notes or not? Tell me, you have got the notes or not? Good. So in the notes, there are the discount factors given. Discount factors are given in the notes, second or third page. Please calculate NPV at 12%. Everyone. It is the page number 8. 12% discount rate. 1.893. Here is the discount rate, discount factor. Point 893, 0.797, 0.712, and 0.636. Here you calculate present value and NPV. Yes, please. $233 positive. Okay, calculate another NPV at where to get the access to the notes. Okay, let me show you. This is our website opening in front of you. Come to the here. This is December 2022 FM. Here is the FM. Where is the FM? Oh my God. Here it is. Just click it. Curriculum. Here there are notes, volume 1. Simply click it, preview. And you can click here. It will be downloaded. Simple as that. So NPV at the rate of 18%. Please calculate and give me. minus 111. One answer received. Anyone else who has calculated? Anyone else who has calculated? Now, so yes, the same. So let us calculate IRR. The same formula I'll apply. Lower rate is 12%. Plus NPV at lower rate, 233. NPV at lower rate minus is from formula. And minus 111. This one. Into higher rate 18% minus 12%. Yes. Give me answer, please. Note it down and give me answer, please. Note it down and give me answer, please. What is the answer? .1599. It is 16%. It is 16% answer. Very good. Now I will explain it. Student, 16% is the IRR. It means the project will yield 16% return every year. Cost of capital is 12%. If IRR of a project is greater than cost of capital, we say accept the project. And if IRR is less than cost of capital, it means return is less than cost, loss. We say reject the project. Reject the product. Now, IRR advantage, disadvantage. First of all, we will discuss how IRR is calculated by graph. You calculated NPV is here and discount rate is here. At 12%, it was something positive. That is 200 positive, 233. Then on 18%, it was 111, negative. And if we join the both points, here is NPV 0. This is IRR. This is NPV at lower rate. This is NPV at higher rate. This is IRR, where NPV is 0 now. This is the return of the project. And that's why we say, why? There is another definition of IRR. If projects cash flows are discounted at its IRR rate, NPV will be 0. Why? Because discounting at IRR means that we are deducting all the project's return from it. I repeat, discounting a project's cash flow at IRR means that we are deducting all of its return from the project. That's why we say it is 0. Now, next. Let us proceed further. Student, for example, at both rates, NPV at higher rate is this, and NPV at lower rate, is this, NPV at higher rate is this. And both are positives. It might be possible. It is possible. Then this is the IRR. This is the IRR. Another example, third one. For example, both NPVs are negative. NPV at lower rate and NPV at higher rate. It might be possible, both are negative. Then this is IRR. Note down these three diagrams, and if you feel there is any confusion, please ask. Is it clear, students? Tell me. to everyone? Is it clear? Is it clear? Tell me, please. Good. You see, students, in this diagram, we had 2 points, this one and this one. And we found a point between 2 points. This is called interpolation. Finding a point between 2 points. In both cases, we had 2 points and we found a point beyond these 2 points. This is called extrapolation. Finding a point beyond 2 points. Extrapolation. And interpolation. Now, IRR advantages and drawbacks. Advantages of IRR method. First of all, cash flow based. Considers time value of money. Considers full life of project. Yes. Easy to understand. But there are drawbacks. We are very much technical. Okay, but the first one is easy. It is a relative measure. Now, what does it mean? NP was absolute measure, absolute giving exact answer. Relative, answer in percentage. And percentage answer, I told you when I was discussing ARR. The percentage may be high, but exact amount may be small. So relative measure. Second, while calculating IRR for non-conventional cash flows, sometimes multiple IRRs are generated or no IRR. What does it mean? Note it down, I will explain. Non-conventional cash flows, multiple IRR and no IRR. Three things I have to explain. Now, just see here. Student, what are conventional cash flows? Initially outflow, then inflows. This is called conventional cash flows. This is called conventional. What is non-conventional? Initially outflow, then inflows. Then outflow, then inflow, then outflow. Means multiple times outflows. They are called non-conventional. When we calculate IRR for such projects with non-conventional cash flow, what happens? Multiple IRRs are generated. It gives IRR more than one answer. For example, 20% and 45%. Now, which one is correct? We do not know. We do not know which one is correct. Or sometimes they say error. We cannot produce any answer. No IRR. Or sometimes 2 or sometimes 3 IRRs are generated. Now, next. Let us proceed further. Students, third, drawback. Is it clear? This drawback is clear to you people. This one, second. Tell me please, is it clear conceptually? Good. Third one. IRR assumes that this method, cash flows of projects are reinvested at a rate equal to IRR, which is not possible if IRR of project is too high. Note it down and I'll explain. Note it down, then I'll explain. Note it down, then I'll explain. Note it down, then explain. That the cash flows of projects are reinvested at a rate equal to it. For example, IRR of project is 25%. Cost of capital is 10%. IRR assumes that cash flow, excess cash flow, they are being reinvested at 25%. Too higher rate. Practically, it is not possible to find a different project with same rate for reinvestment of excess cash. That excess cash is being reinvested at similar rate of return. NPV assumes that they are being reinvested at cost of capital, which is quite reasonable. So IRR, this assumption is not appropriate. Okay? Because it is not possible to invest the cash flows at similar higher rate. Now, next. Let us proceed further. The next topic is IRR is done. Annuity and perpetuity. The next topic is annuity and perpetuity. Right. Annuity. What is annuity? Students, we know the discount rate. Now, what is annuity? Annuity is a series of cash flow with constant amount. At constant interval for a limited period of time. For a limited period of time. This is called annuity. For example, we say you will get 7,000 every year. Constant amount at constant interval for limited means known. Limited means known period of time. Known period of time. Known period of time. Now, this is called annuity. Its present value can be calculated. Annual cash flow into annuity factor. For example, discount rate R is equal to 10%. So what is the annuity factor? What is the annuity factor at 10%? Yes, you have annuity table on the page number 9 of notes. Page number 9 of notes. 10% for 5 years, 3.791. Annual cash flow is this 3.791. 10% for 5 years. I say you have annuity table on the page number 9 of the notes volume 1. You simply multiply. This will be the value of all these cash flows. 26,537. Two six five three seven. Now, next. I hope it is clear. So this is the present value of all this annuity. Annuity is of 3 types. One is called simple annuity. Simple annuity, where cash flow starts from year 1 or next year. This is the example of simple annuity. This is the example of simple annuity. We have done. Then is second is delayed annuity. And the third one is annuity due. Annuity due. So annuity due, what is it? Where cash flows starts from now or year 0. Let us discuss first this. Annuity due. Annuity in advance, it is also called. Now, for example, 0, 1, 2, 3, 4, and 5. 7,000 cash flows starting from now. Students, if we forget it for the time being, for example, forget it. Forget it. This is simple annuity. This is simple annuity. So its present value. Annual cash flow into annuity factor. Simple annuity factor. But there is year 0 as well. For year 0, discount factor is 1. So for year 1, 1 plus annuity factor. So 7,000 into 1 plus annuity factor for this one. 5 year, we have already derived 3.791. Here will be the answer. 4.791. It is 33537. Double 3537. This is the present value of annuity in advance. Is it clear? Annuity in advance is clear? Any confusion, any question? Please tell me. Is it clear? Right. Let us proceed further. Delayed annuity or deferred annuity. Where cash flow starts after year one. Where cash flow starts after year one. For example, 0, 1, 2, 3, 4, 5, 6. Okay. Make it 7. Cash flow is starting, for example, from this year. After year one, maybe starting from year 2, 3, 4, 5. For the time being, assume this is year 1, 2, 3, 4, and 5. For the time being, forget this one. This is simple annuity. So present value is equal to annual cash flow into annuity factor. Annual cash flow into annuity factor 3.791 for 5 years. But the point is, this is not year 1 and this is not year 0. Whatever answer we will get, that will fall here, which is year 2, 1 year back. And that answer we have to take to year 0. That answer we have to take to year 0. And now you see here, it is 2-year discount factor. Or if it is year 3, then 3 year. If it is year 5, discount factor 0.826. This will be the answer. It is 21919. Deferred or delayed annuity. Deferred or delayed annuity. Students, R is equal to 10%. Tell me its answer through annuity. Calculate on paper. You are not in the WhatsApp group. WhatsApp group have been created or not? Let me check. Okay, you have not been added yet. Okay, you will be added, I think. No, edit. Already edit. You are already part of the WhatsApp group. Okay, so solve it on a paper, take its picture and send the screenshot in the WhatsApp group. Here, send solution here. I said send the picture in the WhatsApp group, please. I don't want answer. I want the process. I want to see the process. I'm interested in that, dear Abhishek. Please, if you have solved on the paper, send that paper picture in the WhatsApp group. Everyone, please. Only 2% solved. What about others? What about others, please? If it is not clear, do let me know. I'll re-explain it. I need answer. I am not going to proceed further if you will not speak or you will not share the answer. I'm not going to proceed. Forget about it that I will proceed further. I want answer. If you are not getting it, tell me. Good. I want to make sure, students, for your betterment, I'm emphasizing. Thank you, everyone. Thank you, everyone. Now, so it is 15,000 into 3.170 into 0.751. This is done. So annuity is done. Perpetuity. Perpetuity. The next topic is perpetuity. Students, let us take a 5 minutes break. Okay? Some short break. And then we start perpetuity. Have a 5 minutes break. And then we start. Okay? Just 5 minutes. Yes, students, everyone now. Perpetuity. What is perpetuity? Perpetuity is something which is based on annuity concept, same concept. Perpetuity is also a series of cash flow. A series of cash flows with constant amount. Second, constant interval. But the third is for unlimited period of time, unlimited or indefinite period of time. For indefinite period of time. For indefinite period of time. For example, you will be getting 7,000 as from next year till perpetuity. So present value is equal to annual cash flow into 1 over R. 1 over R is perpetuity factor basically. 1 over R is perpetuity factor basically. Yes. It is perpetuity factor. Now, one over R is perpetuity factor. So R is, for example, here 10%, 7,000 into 1 over R, 70,000. This is the answer. This is the answer. Now, next. Student, perpetuity is of 4 types. One is called simple perpetuity. Perpetuity due. Delayed perpetuity. And perpetuity with growth. And perpetuity with growth. So, simple perpetuity. We have talked about that, where cash flow starts in year 1 or next year. Perpetuity due, where cash flow starts from now or year 0. Just see here, example. Year 0, 1, 2, 3, 4. You are getting 7,000, 7,000, and so on. So same logic. From here to here, simple perpetuity. So annual cash flow into 1 over R. And for year 0, 1 plus. So 7,000 into 1 plus 0.1. It is 77,000. Perpetuity due. Next is the delayed perpetuity. Delayed or deferred perpetuity. Where cash flow starts after year 1. For example, starting from year 5 till perpetuity. For this, it is simple perpetuity. Answer will fall here. Same logic that of NOT. So annual cash flow into 1 over R into discount factor. .683. Here will be the answer. Deferred or delayed perpetuity. Deferred or delayed perpetuity. Next. Perpetuity with growth. Where cash flow grows at constant rate. At constant growth rate, where cash flow grows. Yes. Now, how to calculate present value? CF1 over R minus G. CF1, cash flow in the first year of perpetuity. G is the growth rate. For example, you will get 7,000 in the next year and then it will grow by 4% every year in the foreseeable future. R is equal to 13%. Okay, make it 14%. Okay, what is the present value? CF1 7,000, R 0.14% minus 0.04, R minus G, 70,000. Perpetuity with growth. Perpetuity with growth. Student, is it clear so far? Any question, anyone? Yes, please. Any confusion, please? Yes, please. Others? Good. Now, another example. Then I'll proceed with the NPV and adjustment. One more example. 0, 1, 2, 3, 4, 5. Cash flow starting from here will grow at 3% per annum. R is equal to 12%. Calculate present value. Calculate, everyone. Try it. Be quick. Solve it, everyone. Try it. Think about it. It can be solved. Student, this is perpetuity with growth and deferred as well. For if I forget it, that it is starting from year 3. What is the answer? 5,000 R minus G. Simple is that. Answer will fall here. 2-year discount factor at the rate of 12% for 2 years. Simple is that. Now I will see the discount factor from the discount table. Just a minute. %, for 2 years. Oh, sorry, 12% for 2 years. 0.797. This will be the answer. Simple is that. Deferred perpetuity and delayed as well. Is that clear to you people? Now, I will proceed towards NPV and adjustments. Come on. Let us start it. The topic. In the next class, we have to do practice question. So that's why it is mandatory to prepare today's lecture and last lecture before next class. I'm telling you in advance. Students, the adjustment, NPV and inflation. First of all, what is inflation? Inflation is increase in prices, called inflation. Inflation is of two types. One is called general inflation. The other is called specific inflation. The price of petrol increased by 10%. It is specific inflation. Price of cooking oil increased by 20%. Specific inflation. Price of wheat increased by 2%. Specific inflation. Price of rice increased by 5%. Specific inflation. What is general inflation? Generic increase, average of the weighted average of the bucket of necessities of life. That is your general inflation. Now, impact of NPV, inflation. Impact is on two sides. One is called cost of capital, discount rate. The other is called cash flows. Cost of capital is of two types. One is called money or nominal cost of capital. The other is called real cost of capital. For example, it is that cost without impact of inflation. It includes the effect of inflation. Now, for example, it is M. For example, it is I. There is a Fisher's formula. Fisher is a person. They gave a formula to have a link between the 1 plus M is equal to 1 plus I into 1 plus H. H is general inflation. For example, real cost of capital is 10%. General inflation is 5%. What is M? 1 plus I 10%, into 1 plus 0.05, 5%, minus 1 is equal to M. 15.5, I think, percent it will be, if I'm not wrong. Yes, 15.5%. Now, cash flows. They can be money or nominal cash flows, which are also called inflated cash flows, including the impact of inflation. Then there are the real or current cash flows without impact of inflation. Without the impact of inflation. Yes. Now, next. Students, why we are studying it? Actually, there are approaches to calculate NPV. Approaches to calculate NPV. There are two approaches. One is called nominal approach, and the other is called real approach, nominal or money approach. Nominal approach is simple, that inflate all cash flows, calculate net cash flows, and discount at cost of capital. Simple is that. Inflate all cash flows with specific inflation, discount them with the nominal cost of capital, you will get NPV. Now, next is the real approach. Then is the real approach. What is real approach? Real approach is the first one. Two cases may be there. General inflations and specific inflation are same, different. If they are same, life is easy. If they are different, yes, there is some mess. If they are same, okay, calculate net real cash flows. Need not to inflate anything. And discount them at real cost of capital. Real cost of capital. These rules you need to memorize. You need to memorize these rules before next class. Now here is some mess. Calculate pre-tax inflated cash flows, convert them, calculate inflated cash flows into real cash flows, discounting at general inflation rate, discounting at general inflation rate, discounting at general inflation rate. Then real discount, real cash flows calculated above using real cost of capital. It is a bit messy. I will show you the calculation. We have to do a question on it from past lectures. Now, next. Let us proceed further. So this is the impact of inflation done. Then you need to memorize these steps. Now, next. The next adjustment is NPV and taxation. NPV and a taxation. There are again impact on cost of capital and cash flows. Cost of capital. Always use post-tax cost of capital unless stated otherwise. Pre-tax cost of capital, if it is given, into 1 minus tax rate, that is equal to post-tax cost of capital. For example, pre-tax cost of capital is equal to 12%. Tax rate is equal to 25%. What is post-tax cost of capital? 12%, 1 minus 0.25. It is 9%. Now, cash flows. Cash flows, impact of taxation is on two sides. One is tax payment on taxable cash flows. The second is tax saving on capital allowance. Tax saving on capital allowance. Now, tax payment on taxable cash flows. That you have to pay tax every year. Whatever you earn on that at the tax rate, very easy. For example, sales minus costs. This is taxable cash flow. And you have to pay tax maybe in the same year or in the area. For example, it is 30% in the same year, then here. If it is in area, then the next year. Then tax saving on capital allowance. Tax saving on capital allowance. That is, capital allowance is basically depreciation charge allowed by authorities by which taxable profits are reduced. It is a depreciation charge allowed by taxation authorities by which taxable profits are reduced and hence tax is saved. You have to pay less tax. For example, let us learn with the example. Initial investment is that is equal to, okay, let us solve it here. 150,000. Scrap value is 10,000. Life is 4 years. Straight line method of depreciation, have straight line capital allowance. Is at straight line, tax rate is 30%. So 4 year life in same year, tax is in same year. Let's see here. 0, 1, 2, 3, and 4. What is capital allowance every year? Capital allowance every year. Straight line method. How to calculate? Initial investment minus scrap value divided by life. It is 35,000. 35,000. Capital allowance. Tax saving at 30%. Same year. So 30% of 35,000. 10,500. This is the tax saving on capital allowance. If the method is straight line, if the method is reducing balance method, it will be different. a bit. Note it down, please. If there is any question, ask me. Should we proceed further? Is it clear to everyone? Tell me, tax saving on capital allowance, is that clear to everyone? Tell me, please. All right, let us proceed towards the other method, reducing balance method. For example, they say capital allowances (25% reducing balance method). All data is same. 0, 1, 2, 3, 4. Now, first of all, we need to calculate capital allowance. First of all, here is the value, written down value, capital allowance. Here written on value in the start of first year, that is 150,000 into 150,000 into 25%. 37,500. It is 112500. 28125. $84375. And the final year, reducing balances, remaining balances, year 4, 63281. And they say scrap value is 10,000 minus 10,000. The remaining will be charged, the whole 53281 here. Capital allowance is here. Capital allowance is here. This is from F3. Capital allowance calculation. And now tax saving, that is 30% in the same year. Double 1250. $8437. 6328. 15,984. Here it is. This is the tax saving on capital allowance. We have calculated. Note it down, please. Now, students, I hope you have noted it down. I will be writing a point here and you will be calculating tax saving on capital allowance on paper, and you'll be sending the picture in the WhatsApp group again. Initial investment is $75,000. Scrap value is 5,000. Life is 5 years. And capital allowance is 30%, reducing balance basis. Reduce life to 4 years to make it quick. Yes, tax rate is 25%. Calculate tax saving on capital allowance, cash flows. Be quick, everyone. Be quick. Send me answer. Yes, please. Be quick, please. Solve it and send me. Be quick, please. Receive 2 answers. Please send me. Okay, these answers are correct, but other people should also share. This is unfair, you know. I keep asking share, 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 and then 2 or 3 people share. Now, next. Students, the last adjustment which we have to discuss today, that is NPV and working capital. Adjustment. They say that working capital 10% of sales will be required at start of every year. Now, you see here, for example, 0, 1, 2, 3, 4. Sales are like that. Sales are 70,000, 75,000, 79,000, and 81,000. Now, what is working capital required? 10% of it, 7,000. 10% of it, 7,500. Start of year means in the previous year. Start of year means in the previous year. 10% of it, 8,100. Now, just see here. Incremental working capital. Incremental working capital. 7,000 is required, outflow of 7,000. Next year, 7,500 required. 7,000 is already present. Additional 500 outflow. Next 100, 7,900 required. Next year, 79, 400 outflow. Then 200 outflow. Total outflow so far is 8,100, and all will be recovered in the final year. Note it down. All 8,100 Is it clear, students? Is it clear? Tell me, please. All right, good. Another example. Working capital of 50,000. This is example 2. 50,000 will require at start of project and will increase by 5% per annum. That's it. For example, this is a project. So working capital, we need to calculate. 50,000 is required as then 5% increase. So 5% inflated. Now, so 50,000 into 1.05, 52,500 into 1.05, 55,125 into 1.05, 57,881. Sorry. And the next is 60,775. Now, this is the working capital 5% increase. Incremental working capital 50,000 required initially, then difference 2,500, then difference. Two 625, then difference. Two 756, and then 60,775 minus 57,881, 2,894. And now this is total outflow. This will be inflow in the last year too. So these are this negative and this positive. Net it will become, and this will go to the net cash flow of working capital. What is the net? If you calculate net, it will be 57,881. So in the final year, instead of writing this, you will write simply this here. Instead of writing 2, write this one here. Note it down, please. Is it clear, students? Tell me, please. Is that clear? to everyone. All right, students. You see here, we have done today's task. Well, in the next class, we will be doing practice and investment risk and uncertainty. And you see here, test is approaching near. Test is approaching near. In the next class, practice and then practice. Here as well. Practice and practice. And I may conduct one additional practice class before test. That may be addition to the normal class, I'm telling you. Okay? So, students, now come to the notes. Let me show you from the notes what you have to revise from the notes. Starting from the, starting from the page, this one, 34, class lecture, you see here. From 34 to 40, page 40. This is one you have to prepare at home. 34 to page 40, 40. This is what you have to prepare at home. Well, in the next class, risk and uncertainty I will discuss. We will be doing practice questions. And if we have time, I will discuss capital rationing as well. I'm telling you. I will be discussing capital rationing as well in the next class, if needed. I'm telling you in advance. Yes. So anyways, thank you for joining me today. We have done today's task. See you on the next Saturday. Number of students are absent today. I don't know why. So see you next week. Take care. Goodbye. Goodbye.